Hello dear students, welcome to Devika's Commerce and Management Academy. Amalgamation. In the last class we have seen how to write the journal entries in the books of transferer. Okay, now today we'll see transferee. Transferer means who is selling, the company, vendor. Now today we are going to see transferee means who, the person who is purchasing, the company which is purchasing company. In the books of transferee, how to write the journal entries. In transferer, we have simple journal entries. When it comes to transferee books, we have two methods to follow. One method is the pooling of interest method. Second one is purchase method. You must know whenever the problem is given related to amalgamation, is it a pooling of interest method or merging method? Which method it is? According to that, we'll be passing the journal entries. In the problem, it will be given. Pooling of interest method means this is nothing but a merging method. Purely merging method. Like completely merging without making any changes in the assets and liabilities. Assets and liabilities, we are not changing anything. As it is, we are merging. As it is, we are transferring. That is, we call it as the pooling of interest method. Whereas in purchase method, some changes will be there. Okay, now let's focus on the pooling of interest method. Means we are making some, as it is, the assets and liabilities transferring from the vendor to the purchaser. Entries are very less, only 4 entries, 1, 2, 3, 4 entries only. But major changes you have to remember. Now first entry is here for the purchase of business. This company is purchasing. In the books of transferee, we are saying, transferee means purchaser. Okay, in the books of purchaser. Now here for the purchase of business, first company is purchasing the business. When company is purchasing the business purchase account. Whenever you are purchasing anything, simple journal entries also we used to write the same entry, purchases account at R2, from where you are purchasing, same entry. Business purchases account at R2, liquidated of transferring company, from where we are purchasing, from the transferred company. Liquidator of transferred company account is credited, means vendor. Simple words, vendor, but we are using typical accounts language, that is liquidator of transferred company account. Business purchases account at R2, liquidator of transferred company account. This is first entry for purchasing the business. Able to remember? Now second entry, assets and liabilities are taken over. We are taking over. Who means we are purchasing companies taking over the assets and liabilities. For that entry, for assets and liabilities taken over, simple, remember all the assets debit side to all the liabilities. All the assets data to all the liabilities independently you have to write, separately you have to write. Okay, sundry assets account data to sundry liabilities account, and business purchase account. Business purchase already we have written on the debit side. Whenever assets and liabilities are taken over, this business purchases comes on the credit side. Same one, business purchases comes on the credit side, debit to credit side. When you pass this entry, you will be getting balancing figure. If the balancing figure comes on the credit side, general reserve. If it comes on the debit side, also general reserve. Point to be noted. Once again I repeat. So when assets and liabilities are transferring, generally we get a difference. The difference we call it as a if it is on the credit side, general reserve. If it is on the debit side, we used to say it as a goodwill. Now here no goodwill. No goodwill. Simply whatever comes, whether you are getting balancing figure on the credit side or debit side, wherever it may be, you will say general reserve. Difference, balancing figure. This we have to balance. Balancing figure is general reserve. Maybe credit side, maybe debit side also. Wherever it may be. This point you have to remember. Second entry is over. Now third entry is for making payment. This is for taken over assets and liabilities. For making payment, who has to make? We have to make. Purchasing company has to make the payment. To whom we are making? Vendor. So vendor account at R. Vendor, what do we call vendor? Liquidator of transferred company account at R. Debit the receiver, debit the vendor. So liquidator of transferred company account at R. How we are making the payment? If it is making through the cash, we say generally all the transactions are made through the banks. That is why rather than using cash, we use bank. So how we are making the payment? Through the cash means bank. And sometimes you may be giving shares also. So share capital account. Shares can be preference shares or equity shares, whatever it may be. So that share capital. And sometimes you may find securities premium. Means if the shares are issued at premium, if it is issued at premium, then only if any. So that is also making payment through premium. If suppose the shares are issued at par, same value, no premium. If you find premium, so premium also we are making payment. So that is also comes under the mode of payment. Are you getting it? So for making the payment, debit the vendor. Who's the vendor? Liquidator of transferred company account. Liquidator of transferred company account at R to how we are making the payment. To bank, to share capital, to if premium is the share premium. So in that way, this is for making the payment. Able to remember? First one is purchasing the business. Second one is transferring the assets and liabilities. Third one is what is this? For making the payment. Last one is for payment of liquidation expenses. Expenses we have to make the payment. Expenses whenever you are making the entry comes general reserve account at R. You never heard this, right? First time you are hearing. Why to transfer to the general reserve account? Assuming that this is through the general reserve. So general reserve account at R to bank account. General reserve account at R to bank account. Making the payment na? So making the payment. So credit what goes out. We are making payment through the general reserve. So general reserve account at R to bank account. Very rarely some people use it as a goodwill account also rather than general reserve. Goodwill account at R to bank, this is also correct. Let us follow one only, that is general reserve account at R to bank account. 4 entries. This is the pooling of interest method. Now you see the purchase method. Almost similar, small differences that we'll see what are the differences. Purchase method. Purchase method, in this method first entry is same as it is for purchase the business, for the purchase of business. Same entry, business purchase account at R to liquidator of transferor company account. Business purchase account at R to liquidator transferor company account, same. No change. Okay, now second one, for assets and liabilities taken over. Assets and liabilities taken over. Here what happened? Sundry assets individually, okay, that are to liabilities to general reserve and to business purchases. Here also various assets, sundry assets or various assets the same, okay. Various liabilities, business purchase, this is also there. Now where the difference comes? Here balancing figure we used to call it as general reserve only, balancing figure, whether it may be debit or credit. Balancing figure in this pooling of interest method, balancing figure will be always general reserve, maybe debit or credit. Now when it comes here, like old method, if the difference comes on the debit side, goodwill. If the difference comes on the credit side, then general reserve. Please remember this point. This is the difference between the pooling of interest and merging method, purchase method. Okay. So there we say general reserve only. Now here debit side means goodwill, credit side means general reserve. Now coming to third one, for making payment. Making payment, same entry. Liquidator of transfer company account at R to whatever you are making payment, however you are making payment, same entry. Easy to remember if you see like this, okay. 3 entries are over. Out of 3 entries, first one and third one as it is. Second one only one difference, that is difference comes on the debit side, goodwill. Difference comes on the credit side, it's a general reserve. Now coming to the fourth entry, for payment of liquidation. For payment of liquidation, generally we are saying general reserve account or goodwill. but here only goodwill. Only goodwill, no general reserve. There we said general reserve. Okay, now here goodwill account. This is the difference. Goodwill account attached to bank account for making the payment. 4 entries are over 1 2 3 4 1 2 3 4. Now fifth entry, extra entry is there here. If it is a merger, sorry, if it is a purchase method, fifth entry is here. When statutory reserve is maintained, statutory reserve specially it will be given in the problem. Whenever statutory, compulsory, mandatory reserve is there, that is to be transferred to the purchasing company. For that purpose, we'll write the entry. If the company is following the purchase method, you will find if you find, you pass the entry. If statutory reserve is not given, then ignore this entry, not required. In that method, you will not find this. Only in purchase method, you may find statutory reserve. If it is maintaining, the entry is amalgamation adjustment reserve account attached to statutory reserve. Statutory reserve is credited. Debit side, what you are writing? Amalgamation adjustment reserve account. Say amalgamation adjustment reserve account attached to statutory reserve account. This is the new entry, which is not there in the pooling of interest method. Am I clear? Very important. Simple 4 entries only, and same entries here. Only the difference is here goodwill, and for making payment also general reserve, here goodwill. Statutory, if at all given, then we'll take. What is the entry? Amalgamation adjustment reserve account attached to statutory reserve account. Clear? Now what is the difference between the pooling of interest method and purchase method? Through a table, it's easy to understand. First thing is that amalgamation in the nature of merger. This is pooling of interest is amalgamation in the nature of merger, means purely everything is transferred without any adjustments, as it is, without any changes, it is transferred. That is pooling of interest. Whereas purchase method, amalgamation in the nature of purchase. Nature of purchase means maybe some changes. Okay, and second difference is reserves are recorded in the books of transferee. Reserves are recorded in the books of transferee. If you see the transferee, if you see this, reserves are recorded. Now here statutory reserve is recorded, normal reserve is recorded, and also statutory reserve is recorded here, this one. Okay, now here we are not saying reserve, only at this point statutory reserve is recorded. Now here normal reserve also recorded. Third point is the difference between assets and liabilities taken over is transferred to only general reserve. This one, this point. Here the difference is transferred to only general reserve. Assets and liabilities taken over entry, the difference between assets and liabilities taken over is transferred to only to general reserve. Okay. Now here it can be goodwill or general reserve. The difference between assets and liabilities taken over is transferred to general reserve or goodwill. Entire sentence I did not write. I think you can understand. General reserve or goodwill. These are the main 3 differences. Easy to remember, right? So if you follow this, next class we will work out problems. Easy, need not to worry. Liquidation is quite easy, you know, final accounts. If you learn journal entries, it's quite easy. Want to take screenshot? Yes. Hope you are maintaining a book. So write down it neatly, refer the previous class also, and the next class will have journal entries. Check out the playlist. Many subjects already covered. And also don't forget to share this video. Stay connected. Good way. Good luck.